Hello, chart watchers, and welcome to this Thursday, May 24th Market Watchers Live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the market was taking a beating earlier, but it is trying to reverse at gap support on the Dow. You can see we came back down, tested this gap area around 24,750, actually went below it, but we have bounced since then. Still down 147 points, though. The S&P 500 remaining in this flag pattern. Was down much more earlier, but down 10 currently. The NASDAQ has bounced back quite a bit off its earlier low. It, too, continues to trade sideways in a flag pattern, down 18.5 points. And the Russell 2000 continues to outperform on a relative basis, actually up a quarter point today. 10-year Treasury yield continues its slide. It is now down below the 3% level, 2.97%. Volatility continues to shrink. It is moving a little bit higher today, but continues in its downtrend. Utility is getting a bounce today. We see that sector up against a couple of key moving averages and getting close to the high it saw about a week and a half ago. Energy falling, coming back down, testing that rising 20-day moving average. Financials doing the same, pulling back, testing the rising 20-day moving average. GE, top performer in the Dow today after a really big down day on heavy volume yesterday. It is bouncing back, trying to get back through its 20-day moving average. That would be a short-term bullish development. ExxonMobil pulling back, part of that energy group, also nearing its 20-day moving average and the level of the breakout that we saw from the April high. And then the best performer in the S&P 500, at least earlier, was L Brands, which is a retailer. And you can see this move up after gapping down to start the day. It is up almost 4% today. And with that, let me bring in my co-host, Erin. Erin, the Caps are going to the Stanley Cup Finals.
Congratulations. Since my Ducks left in the first round, I've been watching them closely for you. It is a little bit hard because, my Pacific Western Conference is the Vegas Knights in their inaugural season. Cinderella team. I know John, my husband, is rooting for the Vegas Knights, and we're kind of on opposite sides because for your sake, Tom, and the fact that, come on, you guys have been working toward this for so many years, I think the Caps should win.
It would not be fair at all for Vegas in their first year to win. They need to suffer for 44 years like we have.
Exactly. Well, of course, the only place they'd go is down from there. I mean, I highly doubt they can continue to win Stanley Cups, but...
That's true. That's true. But anyway, it is an exciting day for us Capitals fans. Not too much to cheer for or cheer about over the last 44 years, so pretty exciting. But anyway, we got lots to talk about in the stock market, so I'll let you take over for the announcements and the agenda. We'll get things going here.
Absolutely. So tomorrow we have everything stock charts. We're going to learn something new about the website. Monday, there will be no show because, of course, the market's taken a day off for Memorial Day. And Tom's got a workshop on Tuesday. I'm pretty sure you don't have a title yet. So if anybody's interested, you can send in survey or even in the chat room ideas for Tom's workshop. And then finally, Wednesday, Mark Chaikin is going to be joining us. But for today, we have sector rotation analysis after our tech headlines, chart breakouts. We're going to look at some of those. We have the 10 and 10 to 1, and the first symbol will be Tiffany and Company, a favorite of mine, TIF. And then we're going to finish with a new segment called Turning Point, and we'll let you know a little bit more about that as we get closer. And with that, I'm going to pass it back to you for some technical headlines, and let's go and get it started.
All right, sounds good. We had a little bit of economic news out this morning. It wasn't great, so we'll go ahead and start off with that. But earlier this morning, we got the initial jobless claims out, 234,000 versus the expected 220,000. So that was a little higher than anticipated. Then at 9 o'clock, the March FHFA house price index came in. It rose 0.1%. The market was looking for a rise of 0.6%, so it came up quite a bit short there. And then just kind of throw some kerosene on the fire. April existing home sales came in less than expected, 5,460,000 units versus the 5.6 million units expected. And so you can imagine not great news there for the home builders. But the home builders have been beaten up pretty badly here in 2018. I'll go ahead and pull that up. Come back to the 10-year Treasury yield here in just a second. But if you look at the DJ USHB, you can see it's been moving lower We did get this breakdown below what was key support prior at 800. And you can see on the rebound went right back to that 800 level, and then quickly we gapped down. But interestingly enough, with some pretty bad news out there this morning, home builders are actually up today, going against the grain. So just kind of shows you that the news and what actually transpires in the market can be on opposite ends of the spectrum. But nonetheless, we have seen some economic reports over the past few months that have shown things are not great right now in the home construction area, and the chart has kind of followed suit to the downside. But as far as the 10-year Treasury yield, let me get back to that, because we do have money rotating today into the bonds, and as a result, we see the Treasury yields continuing this little short-term decline. It's going to be really interesting if we get down to about 294, 293 and test this early May low. We'll also be getting close to the 50-day moving average. It'll be interesting to me to see whether or not we can hold on to this area. I think that will be really important as we move forward, because what's going to happen if we do bounce off of and start moving higher is I believe we're going to see that money rotate back toward areas, the interest-sensitive areas that do well when rates rise, like the financials, which also has struggled, by the way. And we're going to take a look at the XLF in just a minute. But first, I wanted to take a look at the actually, let's take a look at the TLT, which is the bond, a 20-year bond. And you can see we have been moving up the last 5 or 6 days. That's coinciding with the yield moving lower. But overall, I think we're in a downtrend. We had a little bit of a bounce. I look at this as a bear flag coming down. So my expectation is that this bond is going to break down and yields will eventually break back out to the upside. At least that's the way I'm looking at it now. Short term, talked about that 293, 294 area on the yield as it pulls back. Well, I think that coincides with this little bit of overhead resistance between 119 and 120. You've got gap resistance up to 120. You got recent highs just above 119. So I think this is going to be an interesting area of resistance on the TLT. Looking at the XLU, this is an area of the market that really hasn't participated much going back. Well, on a relative basis, it's been struggling versus the S&P 500 for quite some time. But if yields continue to move higher, Treasury yields continue to move higher, I think the XLU will continue to suffer on a relative basis. I still think the market goes higher. I think utilities will go higher as well, but I think they'll go up less fast, if you will. So the XLU is bouncing with the yields dropping, with those 10-year or with that 10-year Treasury yield dropping. But I think this is just a short-term bounce for now. Another area that is benefiting from the drop in the Treasury yields is the REITs. The Dow Jones REIT Index, you can see the last few days also moving higher. Really been in a downtrend going back the last several months, and now just sideways consolidating, maybe a little bit of a tick to the upside here on the DJR. But again, I think this, like utilities, this is an area of the market that's probably going to struggle on a relative basis because of what I think we're going to have, which is the climbing 10-year Treasury yield. Wanted to mention the transports for sure. Let's pull up the transports. 10,800 was a pretty big level. We got through. We went down, and I talk about this quite a bit. You know, I used to only pay attention to the breakout level, and if you came back down and reversed and failed to hold that breakout level, I'd be pretty bearish. But after watching this happen many times, I kind of changed my tune, and it's not just the price support, but a lot of times when they come back down, they don't hold on to price support. Watch that rising 20-day moving average. I think that many times you'll see is a significant reversal. That's what we're getting here with the transports. We went down, essentially almost tested that 20-day moving average yesterday, and now we've got transports up more than 1% today. And if you pull up the sector summary, I'm going to show you when I looked at this earlier, and then go into the industrials, which are second on the leaderboard today because of these transports. Look at what's leading the industrials today. The only 3 industry groups that are up more than 1%, trucking, railroad, airlines, all 3 of the key components within the transports. I find that to be very bullish. I like to see transports breaking out and then holding a key moving average like that 20-day moving average. So I think that is a good news for the transports. A couple of other interesting areas. I wanted to pull up the defense stocks because they have really gotten beaten down, or at least they were really beaten down. They're bouncing back pretty nicely now. End of April, early May, you can see it looks like the chart really fell apart here, and it did on a daily basis. Just about everybody that comes on, though, talks about, looking at the big picture. It's really important to look at the big picture. And maybe some of you who trade really short term might look at a 6-month chart and say this is the big picture, but it really isn't. The big picture is going back and looking at a weekly chart or a monthly chart. I'm going to go back and look at the weekly chart, and I want to point something out here on the defense group. As we moved up to the last high, right before we had all this recent selling, look at the PPO on the weekly chart. We had a breakout. It did not hold. We had a reversing candle, negative divergence on a weekly chart. That almost always results in a 50-period test, at least in my experience. So you have to at least be aware that the risk is higher when you get these negative divergences, especially with a false breakout and a reversing candle like that. We went right down to that 50-week moving average, first test that we have seen going back more than 2 years of the 50-week moving average. The group needed it. The PPO was stretched. It was as high as it's been at any point during the last 3 years. Now the selling that we've seen on the daily chart actually brings this back into, I think, a buyable area. It really relieved not only the overbought conditions, but it also was good in relieving that negative momentum. I think that momentum issue has now been resolved with that 50-period test. So I think the defense stocks, which I've said many times on here, are a key important ingredient of just about any portfolio, because defense stocks do tend to move up in just about any market. And they also tend to move up throughout just about the entire year. From a seasonal perspective, they tend to do well throughout the year. Very unusual. Not too many industry groups do that. Let's take a look at a couple of other key industry groups. First, software within the technology area. You can see software went down, tested that 20-day moving average, turning back up, really at a key area at about 2,100. If we can get this breakout above 2,100, I think it would be really important for a couple of reasons. Number one, we made the breakout about 2-3 weeks ago above the March high, pulled back, hit that rising 20-day moving average, and turning higher. This is very bullish action. A lot of times when you're consolidating, you really can't bank on these moving averages in a consolidating market, because they really just don't help. They're more of a trend following kind of a support. And so this is starting to behave much more like an uptrend than sideways consolidation. So I think that's really good news. The other thing is, with this latest move to the upside, notice that the PPO was pointing straight higher. That means that the momentum is building. It's accelerating. And when you get that kind of momentum, you want to see that rising 20-day moving average hold. If you go back and you look in prior periods when you've got that rising PPO, normally when you get these pullbacks, you hold the 20-day moving average. I would have expected it to hold there in February, did not. Of course, that's when the whole market sold off. But when it started regaining its strength again, here it came down, reversed right on the 20-day, went to a new high. That's what I'm looking for here with software. So very important to watch this one into the close today and for the next few days. Another one that bounced right off of the 20-day moving average, very important, internet group. You can see here a beautiful breakout above the prior April high, pull back right to the 20-day moving average, trying to rally back. Very similar to software in that on this move, you can see the PPO accelerating to the upside, which we like to see, and so far holding that rising 20-day moving average. Many of these industry groups that have started to look more bullish, we're seeing these golden crosses where you've got the 20-day moving average moving above the 50-day moving average. That's always a bullish signal as well. So anyway, I think the market here is looking pretty good. Wanted to point those out. With that, I am going to turn it over to Erin. She's got a couple of upgrades and a downgrade for you. What do those charts look like, Erin?
All right, let's look at them. We have 4 upgrades to look at and 1 downgrade. Okay, let's get to the spot I need to be at. All right, so here's our first. I'm going to go over the downgrade first because it's right on top. And, the PMO has been confirming that this is going to be a problem. You can see that it is topped. The top is actually below the prior top. So we have a big time negative divergence. This one was already showing some signs of wear. I think the good side is you do still have a high scooter. You can still see that volume is not really pulled back on this pullback, but we've got, we're looking at some pretty high volume for only being halfway through the session. We've broken this very important support line, I would say, as well. You can see trading well below that. So I think that when we like to go bottom fishing sometimes from our downgrades, I would say this was a pretty applicable downgrade. I would be staying away from it. Apellis Pharmaceuticals came in with an upgrade. I would be very careful with this one. I'm seeing a reverse flag in play here. And a reverse flag would suggest that the length of the flagpole, if you break down from the flag, that's how far you're going to go down. And that looks pretty close to this area of resistance or support in this case. So, the scooter's improving, but volume and the PMO are really ugly. I would, even with this upgrade, I don't think I would be putting that on my watch list. I thought this one, Avgo, was pretty interesting today. You see the PMO is now creeped right above the zero line, so that's good. That shows that there's finally some internal strength building, although we've seen similar situations back here, and then that preceded a big downtrend. Really, when you look at this, we're in mostly a trading zone here between, right around 220 and 250, 255. So we're right in the middle of that zone. We did break out a little bit from, the consolidation we were seeing if you look over in the thumbnail. But I'm not really thrilled with this one. I suppose you could make a case for a flag. The 50 is below the 200. Again, I think I would be looking for a better choice. We haven't looked at Alibaba in a while, and I find this one quite interesting. We're in a very tight consolidation zone right now. You could make a case for this being a flag, but you can see really the problem is getting over this overhead resistance, and we even have more lying ahead at about 205. But I think what we'll want to do is watch to see if we can get that breakout. If we're getting an upgrade or basically the target was raised for Alibaba and we're not seeing much happen with it yet, obviously the PMO has been trying to turn over, so that's not looking that great. But, I would be watching this one. I might leave on a watch list. It's a big, large cap stock out there, and watch and see if we can get that breakout to the upside. And that would put us above this area of overhead resistance. And I think that would be your sign that things are going to, that flag might end up being executed. And again, the flagpole is the length you should expect the rally to go. So that would put us, let's see, 175 to 200. So about 25 points on 200. So 225 would be the target. I'm not sure what they said with the target, but I think that's a pretty good setup. It's just I personally would want to see that consolidation zone break up to the upside, of course. All right, John Deere and Company. We got the upgrade on this one as well today. This one would have been a great one on the radar, I have to say, if we'd seen this on a scan. I don't run my scan every day, but I think we might have seen this one pop in there on that low, and that was obviously the time to get in. But what I can see is, the PMO is not overbought. It's now above zero, so that's showing some internal strength. We have a scooter that's in the hot zone. We're not seeing any deterioration here on volume. Although I have to say, if you look at the pattern itself, volume has started to decrease on this breakout. So that's not necessarily a good thing. But I think you could still make a case for a possible flag formation here. It still looks pretty good. And look at that 20-50-day EMA crossover in the making. And that would give it an intermediate term trend model buy signal. So I think John Deere might be one you'd want to keep on your watch list. And with that, I'm going to complete those upgrades and downgrades. And I think we'll go ahead and move into our next segment, sector rotation analysis. So I'm going to start it off, if that's good with you, Tom.
That is fine. Go right ahead.
Okay, let's get this on. I wanted to start with my sector rotation chart. I like to throw this up there before we do this segment every time, because for those of you new to sector rotation, I think this is a great chart to have. I will put this in today's Market Watchers Live blog recap. So if you want to grab it from there to keep on your own, feel free. But basically, this is telling you as far as the economic cycle, the business cycle, where we are. And on the outside, it tells you typically which sectors do well during those phases. And really what I look at the most closely are those ones that hit at certain turning points. And consumer staples would be one. If we start seeing strength in the consumer staples, that's telling us we're getting ready to go into a not so great area of the business cycle. Now, this chart is mainly more intermediate to long term, because obviously when you're talking about the business cycle, it's a lot longer than 1 month. But I think that this rotation chart is still applicable in the shorter term timeframes, because you can get a feel for the weaknesses in the market based on where staples are, where utilities are, based on technology and cyclicals. You can see trends happen within a month, couple weeks, and that could tell you that, okay, if we're switching over like we did for a while after the correction, where staples start to lead, that's really an indication that the market is weak right now. And that would be, something to pay attention to. So let's go ahead and look at our sector summary and see where all of these sectors are lining up right now. And I think I'm going to go here. All right, make everybody dizzy. So I'm going to start with the sector summary, and I'm not going to drill down too far into it. So let's see what was going on for the last, 6 months. Which ones are the leaders? And you can see energy and cyclicals over the past 6 months are doing quite well. Obviously, I would say better than their counterparts. Technology is still up there, but that's a great way to look if you're looking for an intermediate term setup. But I want to go down to a 3-month and see whether we have some changes here. Okay, energy clearly a leader. And if we go down to 1 month, we can see that technology is actually doing better than energy if you're looking at it over the past month. I am going to actually look in the technology sector because, energy, as we can see, has been on quite a run. And not that I think that its energy sector is done moving up, but I think there's more opportunity in the technology area because the NASDAQ has been kind of floundering a little bit, especially when you compare it to the small caps. So I think that I want to look in the technology sector. And one way to go from here is to get right in there to the industries within the technology sector. And let's go ahead. We'll look at a leader, but not one that has been leading that much right now. Like telecom equipment is not, but I still think that this is a stronger area in the market, again, the technology. So I want to look at telecom stocks. And at this point, we know that currently the small caps are healthier than the mid and the large caps. So I'm going to do this in terms of the capitalization so that we look at small caps, because I suspect, as the audience did when we did our poll yesterday, that we're going to see the technology starting to do better, and we want to look at small caps because that's where the leadership appears to be setting up. So I'm going to take a peek at a few of these. This is all real time. This is not scripted, so we're going to look at these and just see what we can find. So what I'm going to do is look at the close. I'm not really interested in anything that is too low as far as the closes. That'll typically mean I don't want to see that. It might be a little bit too volatile. And I want to look at something that has a decent scooter. So Oclaro looks interesting to me. While it is a little bit under $10, let's see what that one looks like. The change is huge today, though. All right. So this is an area I like. Notice that the EMAs are set up. We have a buy signal just above the zero line, a gentle slope moving up, and you can see a decent scooter, which is why I picked it. Volume trends mostly flat, but if I would go annotate this, and I'm only going to look at this one and probably one more. First, I'm going to look at the support and resistance levels. So here is some gap resistance, and look at it. That's exactly where we're hitting, is right at the top of this gap, or the beginning of that gap that went down back in April. So this is the area of overhead resistance I need to pay attention to. Everything else is set up on this chart to do well, but I need to see, let's see, I'm going to get a trend line going here. I'll make it thin so that we can see a little better what's going on here. I'm going to fit that in here. All right. So this is something that I would pay attention to. I'm going to pick this because it does look like we've got a kind of a small breakdown here from this rising bottoms trend line. So, and it is tipping just below the 5-day EMA, but we might get an opportunity here if we can pull back toward that 20-day EMA. But I would be very careful. You know, we did in the short term, we're looking at a breakdown, but I think more intermediate term speaking, I like the buy signal. Like I said, I think the indicators are set up in a healthy way. I would watch for that move above, you know, to close that gap resistance. We didn't quite do it earlier. So that would be what I would watch for that one. And let's go look at one more. Let's see, another small cap. This one has sort of a mid-range scooter. So maybe we're seeing some improvement going on there. Let's take a look. All right, so we got 2 gaps down. That would be your, that would probably be the initiation gap. And now we have a continuation gap that I can see in the thumbnail. And the PMO is turning over. So this one probably not going to be on my list to look at. So let's find one that looks decent here. Let's see, Digi. All right, that's a bit better. See, we're seeing the PMO turning up, but I'm not liking the volume on this. So this, you know, we can just go through if you want to hold it over. This one looks interesting because I can see in that thumbnail a little bit of a breakout here. So I'm going to pick this one up now. Yeah, really nice breakout. PMO is a little bit on the overbought side, but I think there's still more potential. And look at the breakout right now above that area of overhead resistance. And of course, this gap got closed quite a while back, so I'm not too worried about that. But that breakout on what could be considered a ascending triangle, I think you could make a case for here, that executed as expected. I'd be watching for higher prices here. I think this one looks pretty good, but it might have made quite a run here when you see the PMO that overbought. And I'm going to pass it back to you now that I've talked.
No problem. All right, let's go ahead and I've got a chart that I want to show everyone. And you talked earlier about the, you know, when you start seeing money rotate into the consumer staples, it's kind of like an early contraction period. And I'm going to kind of follow up on that point quite a bit with a chart that I love, and that is the XLY versus the XLP. And I'll explain why, and then I'll kind of go over all these different lines and what some of this means. First of all, when you think about our GDP, it's estimated that roughly 2/3 of our GDP comes from consumer spending. So it makes a lot of sense that what people are buying can tell us a lot about the economy and whether people are feeling good about things or feeling much more nervous about things. And that nervousness is reflected a lot of times in this ratio here at the top, the XLY, XLP. The XLY is consumer discretionary. The XLP is consumer staples. And consumer discretionary represents the companies that sell the things that we want. Consumer staples are companies that sell the things that we need. So we're going to buy soap no matter how we feel about the economy. At least I hope we do. If not, I'm glad we're doing this online instead of in person. But I think it's really important that you understand the psyche or the psychological impact of this ratio and what it can mean about the market. When people are spending more on consumer discretionary items, and when we talk discretionary, I mean, think Starbucks, think about restaurants in general, think about home building, think about autos, think about all your retailers. Those are the types of things that we're talking about when we're talking about consumer discretionary. We're talking about consumer staples, you're talking about food, you're talking about, household products, the soaps and things like that, deodorant, things that we absolutely have to have. The market makes decisions on which areas that money is going to be invested. And the market also anticipates ahead. So if the market begins to believe that we're heading into an early contraction stage, we're going to see this ratio move lower. And so what I've done is I have the ratio XLY to XLP on this chart, and then I've got the S&P 500 down below, and then I've got a correlation. And this is the correlation between the XLY XLP ratio and the S&P 500. And if you notice, we tend to stay in positive territory. The thing that bothers me is when we go into negative territory and when it results from the S&P 500 going higher, but this ratio not following suit. Here you can see it back in 2007. Big move up in the S&P 500, collapse in this ratio. 2000, right before the bear market. S&P 500 is rising, collapse in this ratio. This is what you don't want to see. Now, the one time throughout this bull market that I really got nervous and I thought maybe we were heading for a bear market was right here, because we had the S&P 500, which was moving higher. Early in this period, you can see the XLY XLP ratio was struggling. We did get a breakout on a relative basis late in 2015, but it didn't hold. And look how rapidly things were starting to fall apart. It just started looking like what we had seen before bear markets. And then we went down, you probably remember this, in early 2016, the S&P 500 went down and tested 2-year lows and didn't quite hit that threshold for a bear market, but it certainly was beginning to feel like one back then. If you look at where we stand right now, look at the XLY XLP. It is absolutely exploding to the upside. Money is rotating hand over fist into consumer discretionary stocks. I find this to be very bullish. So this negative inverse relationship is actually occurring because the ratio is moving up and the S&P is moving down and consolidating earlier gains. I'm not worried about this negative correlation, but I do think that this is a correlation worth watching from an overall perspective, because I think that the market gives us warning signs before we start seeing bear market action. And it was one of the reasons why I just couldn't get into the bear market camp, because the market was not, it didn't feel like a bear market. It didn't feel like the market was preparing for a bear market. Money would not be rotating heavily into consumer discretionary. So I'm still very bullish the market. And this is one of the reasons why when you take a look at the XLY versus the XLP. Now I went through, and I remember back in 2011, I had a bunch of folks when I was with Invested Central, and they were like, why are you not concerned about this pullback here in the ratio while the S&P 500 was consolidating? And I think that this is a big picture kind of a look. You really want to take a look at a big picture when you're looking at this ratio and not try to follow it day by day. Consumer staples are going to outperform consumer discretionary in the short term. Sometimes it's going to happen for a few days. It might even happen for a few weeks or a few months. The thing that you really want to watch is when they are leading the S&P 500 on breakouts. I don't want to see the ratio start dropping on a breakout. That would be a worrisome thing for me. So I just find in sector rotation, when you're looking at sector rotation, this is one of my favorite charts. And when you get back in, getting back to that question, why wasn't I concerned here? I think that these relative charts work in the same fashion that individual stock charts work. You have periods of strength. You have periods of consolidation. I looked at this as an ascending triangle in this relative strength chart. We had an uptrend. We followed it with 2 years worth of sideways consolidation. We broke out. Notice we pulled back. we came right back down to this relative support line, and we kept moving up. Here, I circled why I was really getting nervous here. We were losing relative support. We were turning straight down. The S&P 500 was threatening a breakdown, and we got a big reversal, and we held. And since then, as we've been moving up, you can see that the relative strength line has been moving up as well. So I don't think this is giving us any warning signs. And so this is my look at sector rotation and just showing that I feel like things are still looking up. And again, this is my favorite relative chart. And if you want to duplicate what I've done here, I'll just pull up the screen so you can kind of look down below. But really all it is a chart of the XLY:XLP. You've got this price indicator with the S&P 500, and then you've got the correlation looking at that ratio versus the S&P 500. So it's a pretty simple chart, but it's definitely one worth keeping in your chart list. Maybe just an overall health of the market kind of a chart list. I think this is a really important one. So with that, let's go ahead and wrap up. Let's pull up a summary slide for you all to take a look at. Erin went through some of the things that she looks at in terms of sector rotation, gave you some specific ideas. I took more just an overall view of the XLY versus the XLP picture. And so there you have it on your screen, what we looked at, and we are going to get ready to move into our next segment, which is chart breakouts. And Erin, I'll let you take over.
Oh, okay, perfect. I do want to let everybody know I'm going to bug you, Tom, after the show to send me that chart, a link to that chart, and the link to your treasury yield chart that you show at the beginning of the program, because we do get a lot of questions about that, and I will add that as a link to the bottom of all of our Market Watchers Live articles so that you can get to it and save it as your own.
You really want that 10-year treasury yield chart? All it is the TNX at the top.
Yeah, but you have the one with the comparison, the one that you have.
U.S. rates versus Germany?
Yes, that one.
Okay, all right.
Correct. Yes, that would be a good one. So you can write down that you got to send me that.
Okay.
Okay, so let me get to my screen. So we're going to look at some chart breakouts. And let me go over here. Okay, so I honestly had quite a few chart breakouts. I was looking for some for this segment, but also some for our turning point segment, and we'll get more into that in a bit. So I'm going to go ahead and we're just going to start off. These are basically what I looked for were either gap ups. What you're looking for, is a breakout, obviously, from whatever is going on the chart. And of course, that's what I'm going to be looking at. And I think that most of these have really interesting setups as well. So what I would point out on this particular chart, after I cough, is the flag that honestly, if I look here let me get my circle here. There we go. So you can see that we had this flag, and actually yesterday, you could say was an execution from that declining tops on that flag formation. But I will just say that this was the flag, and we got the gap up. So we're seeing obviously a big time breakout here. PMO is behind it and is not overbought yet. And let me go ahead and I'm going to annotate this real quick just for some support and resistance levels to think about. So I'm going to go over here. This is a giant gap, obviously, that has not been closed yet. So I would be looking honestly for a rise up to close this gap. You're on a good start here. I might wait for a little bit of a pullback here after this gap up. But at the same time, I think you could go in and put your stop in quite tight, maybe right here at the 315 level, depending on what you want to worry about as far as your risk reward go. But I think this one, there's some very interesting patterns going on here. So this was one that I looked at. Let's see. Data, that was real interesting, and somebody else had requested it. Really nice breakout on this one from here we go, ascending triangle here. Really nice look, and if you want to even bring this up here, we've just about gotten a breakout if you want to use that as the top of your triangle, but I think right here is perfect. So we got the breakout today. There is some more potential for a breakout to the upside, given that we haven't quite gotten over that 97.50 area. But if you look in the thumbnail, I mean, we do have today's trading, the intraday high is a little bit above this particular point. So PMO is somewhat overbought, but we've seen it much higher. So I think there's still room to run on data. So I do like data. Let's go, and I wanted to peek quickly at the weekly chart because I know this one actually came up, I think, on my scan today, which is why probably was requested. But there's so much upside potential here. I would be looking back here at this top, and you can see this level as well as resistance earlier. So again, 105, I think, is completely doable here on data. Let's look at Pan W. All right, another breakout, tiny breakout, but that's okay. I like those because then I don't have to wait for a big time pullback. I've gotten the PMO buy signal here, and not quite above that previous top, that PMO top, but I like where this is going. You have an OBV that's trending higher in a good way. You can see the two tops on the OBV are matching up with tops here on price. So that's a confirmation that you could look at, as well as these bottoms rising, confirming the rising bottoms in price. So I think this one has some pretty good potential here. And again, you've got really nice setup on those. Let's see, we looked at that. Brexham SA. Got a little bit of a breakout here. The PMO already had the buy signal, so that's telling us something. We haven't quite gotten all the way to breakout territory. I mean, I was looking at it in terms of this declining trend that had been happening since that gap up. I'd be a little concerned about maybe that same thing happening this time around, but we did get that intraday high that's above this area of resistance. So I think that still is something maybe to add to a watch list. And real quick, and I'll leave you some time. This one was really interesting because I did see the breakout above these previous price tops. In fact, I'm going to actually take this down to a 6-month, and let's make these bars a little thicker. Let's see what we can see. All righty. See, now you can really see that breakout. And again, we've got a gap to close. So I think there is a room for this to run up to close that gap. Could even move higher. I mean, this is a pretty decent chart. The scooter, you know, there are things to keep in mind. 50 is well below the 200. So this is in a bear market configuration. So we may not get a huge run off of this if you're thinking about going, you know, way up here in that 650 range. But the PMO is rising, and I do like that. You can see today on the gap up, on that breakout, we're getting some really nice volume. I would watch to see if we can get this gap to close to about 375. So I thought that looked good. And I'm going to leave that. I think I've got, this was the only other one. I'll just show you another breakout above previous overhead resistance. And I would say it's probably just above that. 50 is just now crossing the 200. So we're moving into a bull market configuration for California Water Services Group and rising scooter. So there we go. Have at it, Tom. It's all yours.
All right. All right. Let's do this. I'm going to take a little different look at this. And my theme for today is consumer discretionary. You're going to find out as I go through the segment, and also turning point later. Really paying some attention, close attention to the consumer discretionary area. Because it is important to see the groups many of the groups within consumer discretionary doing well. One of those groups is the apparel retailers. Yesterday, talked about how the S&P 500 leaderboard was littered with apparel retailers. Well, same thing's happening again today, and you can see apparel retailers at 880 clearing the January high, or at least intraday clearing that prior high. So I do want to see how this closes. But look at the PPO. We got excellent momentum building in this area. Check out the volume coming in. the last couple of days on this move to the upside, I think the group is being accumulated, and clearly this would be a significant breakout in the apparel retailers. Sticking again with the consumer discretionary theme, let's move on to clothing and accessories. Also, one of the leaders yesterday, and again, a leader today, moving higher, up nearly 1%, moving above 340. Haven't had that close above 340 in 2018. This would be a big breakout today for the clothing and accessories group. Group that already broke out, footwear, broke out above the prior February high just about a week and a half ago, continues moving higher. PPO looks good. So while the overall market, we keep talking about the S&P 500, which is not really doing a whole lot, just keeps consolidating, there are definitely parts of the market that look like a bull market to me, and these are just a few of those. Specialty retailers, I think was the next one. The specialty retailers index, coming up off that 20-day moving average yesterday. We had a reversing candle, went down to the 20-day, tested it, and now breaking back out. This is a really bullish ascending triangle. Equal highs coming across, slightly higher lows. I think this is a breakout that's going to send this index much, much higher. One of the big reasons, Netflix. You can see Netflix today breaking out. Well, actually yesterday broke out to a new high. Look at the volume expand yesterday, and it's even stronger today on this move to the upside. So we're getting a breakout of Netflix, which is a key component of that specialty retailers index. Let's see what else we have here. This is specialized consumer services. Made the breakout. Actually, this one is pulled back. I like this pullback to the rising 20-day moving average. We had a flag formation. We broke above it. This is what I was referring to earlier, where you come back down, you fail to hold the support level, which maybe a couple years ago would have really bothered me. Now I just look a little bit lower to that rising 20-day for support, and that's where it looks like we're getting a bounce here. So we did have a breakout in this space, pull back, and now trying to move higher. We move on to broadline retailers. And this is home to Amazon. And by the way, that looks a lot like the Amazon move because Amazon is a big part of this index. But this is another group that is just sideways consolidating, holding on to this 20-day moving average. It had gapped up, failed to hold it on that close. That was the same day that Amazon reported earnings and gapped up and then pulled back. I think we're going to make another run for that level and eventually break out, though. So this is a group that I would be keeping an eye on. Another group that I would be keeping an eye on, we haven't had a breakout yet, but it just seems to be building in terms of bullishness. Nice move in the first half of May, pulled back, holding this rising 20-day moving average. This is one I would pay close attention to because I think we're eventually going to make a run for that 1080. We'll probably be talking about this one breaking out in the fairly near term. One other one that's been pretty good is the toys, but I want to just throw in one word of caution here. It's acting bullishly, nice move up, holding the 20-day, seems to want to make a move here for this 1140 area to test that double top from late January and early March. But one word of caution, seasonality on the toys. Once you get past May, you're going to see that the tendency is for this group to fall off. Check out the first 5 months of the year. Over the last 19 years, you can see that it tends to go up quite a bit. And you look at the average returns across the bottom here, all positive, 3 of them above 3% averages per month, February, March, and May. May is the best month of the year for toys. Once you get past this, you can see that the chances of toys going higher diminishes. And also when you look at the returns coming across here, not nearly as strong as what we see the first 5 months of the year. So while toys look good, I think the seasonality might bring me down just a bit on this particular group. And so I would be careful in terms of trading stocks within this space. And
I didn't like that PPO setup on there either.
Oh, the PPO?
Yeah.
Let's see what we got. Yeah, that PPO is also kind of rolling over. So PMO, PPO kind of warning a little bit. I would be really concerned if we break and lose that 20-day moving average. So with that, that's all I had for the chart breakout. So we can pull up a summary before we go into the 10 in 10 and take just a quick recap of what Erin and I just looked at on the chart breakouts. And there you have it. So Erin went more on the individual stock side, and I was giving you some individual industry groups within the consumer discretionary space.
And there you go.
And now we move on. 10 and 10.
Yes, 10 and 10. I've been busily writing all these down into the chart list. Currently, guys, go ahead and start liking those symbol requests if you haven't already. Right now, AT&T is winning as our second symbol. Let's see. I'm going to go ahead and share the screen so we can look at what we have for the 10 and 10 right now. So we have about 27, which is not too bad. I'm going to show you this in RRG format. And we're going to go to a short-term view using the daily. Take the tails down a bit. And let's fit it and see what's going on. Wow, you guys are picking a lot today that are in that leading space and moving up, moving out of it. There are quite a few of them. Interesting ones I see certainly would be AT&T is one of them, MAS. Those look pretty interesting to me. Now, I don't pick these strictly by the RRG, and I do not pick all of these strictly by their popularity. The only one that gets picked via popularity is the second symbol. So with that, let's do this thing. Let's see how close to 10 minutes you can get today. Starting with Tiffany, one of my favorites.
Right, that sounds like a challenge. Sounds like a challenge.
Indeed.
Okay, Tiffany's. Well, I'm going to give you a little insight into how I look at these gaps, because I think this is a very, very bullish move Tiffany's made yesterday with its earnings report. Huge gap up. I don't know if I have. Yeah, I do have their earnings report right here. They actually beat on the top line 1.03 billion, and their estimate was 0.96 billion. So nice little beat there for Tiffany's on the top line. Bottom line 114 versus 84 cents. So they absolutely blew the bottom line number out of the water. They raised their EPS guidance, and then they authorized a $1 billion share repurchase program. So a lot of good things that they reported yesterday, and the market loved it. Now, what we normally see when we get a gap is, everybody wants to get in, and market makers are on the other side, and that's what leads to gap fills. Well, you can see early we did pull back, but then there was so much demand for this stock. Look at the volume. That is huge volume for Tiffany's. And we went all the way back up, closed near the high of the day. I think this is an incredibly bullish candle. I don't know how far we pull back, but I would be looking for some support first at this 119.5 level, and then maybe we go all the way back down to 116 to test that low intraday. But I don't believe we're going to fill this gap anytime soon, down to 102.50 on Tiffany's. So I trade a little differently when I see a gap and a continuing move to the upside like this. I use the top of gap support instead of the bottom as my key support level. So I like Tiffany's. I think this is a great looking stock. I try to wait and maybe get a little bit better price, but I don't think we're going to see this thing going down to 102.50.
All righty. And let's see if AT&T is still winning the race, and it does appear that it is. So AT&T will be your second symbol.
Yeah, it's more of a defensive play. I'm not a big fan. Huge gap down. What I would maybe look for short term is perhaps a bounce. We're trying to get through the 20-day. That's going to be the first test. And usually when the PPO is pointing down as you're going lower and you bounce, usually you fail at the 20. Check out that little tail went above the 20-day moving average. We came back down, finished below, and then we went down again the day after. That's normally what happens. We're back up trying to get through the 20 again. Maybe we go through. You can tell I'm not exactly thrilled with AT&T. I would continue to watch the 20-day moving average. If we can get through it, I think we're going to run into some serious overhead difficulty at about 33.50.
All righty. See, the next one I'm going to give to you is the Gold Miners Index, GDX, the ETF.
I'm not a fan.
You're never a fan of metals.
Well, I'm definitely not a fan of gold because it moves inverse, and the miners because they move inverse the dollar. And if you've been listening to the program, those who have been listening to the program, I'm very bullish on the U.S. dollar right now. So it'd be hard for me to get excited about the GDX. I mean, could we trade in a range? I suppose. Maybe a better way to look at this is to take a look at the GDX relative to the S&P 500. Let's take a weekly look. And I like to use a line chart as opposed to candlesticks. I'm going to need a little bit more than 6 months there. Let's go take a look over the last 10 years. The biggest problem I have is that we're underperforming the S&P 500. And even in 2017, with the dollar losing 14% of its value, the GDX could not outperform the S&P 500. Now we're in a period where the dollar is wildly, moving wildly higher. At least it has been over the past several weeks. And I just don't think that that's a recipe for the GDX to outperform the S&P 500. So I would just simply annotate this. We all talk about relative strength. Just about every guest we have coming on here talks about relative strength. I think when you're looking at something like that or something like this, it's really hard to get excited. First half of the year in 2016, we had nice outperformance, but there really hasn't been much outperformance over the last 7 years outside of those 6 months. It's hard to outperform the S&P investing in a group that's underperforming that benchmark. So I'm passing.
All right. Let's see. The next one I have for you is MAS. It is our only industrial sector request, Masco Corp.
All right. I'm going to pull this one up using that relative chart style. You can see clearly the stock's been going down. Huge volume on this move down. I think this is a little bit of a flag. Notice after breaking down from the 50-day moving average, we cannot get back through that 20-day. That's why I think it's always important to look at that 20-day moving average. And that was a false breakout. See that tail that went up above that 20-day moving average? Couldn't hold. Let's annotate. So the first thing that I'm going to, just looking at this chart, I think you got to be careful about is, can we get through this 20-day moving average? We certainly haven't been able to do it yet. I would not be interested at all until we could at least get back up through that level. And once we get through the 20, I think we got issues coming in probably between about 38.50 and 38.75. 38.75 being that prior low, 38.50 being the gap down on very heavy volume. You can see the rally failed at that level. We've got multiple tests around 38.50 without being able to get through. So I'm not liking it. If we take a look at the rest of the chart here, you can see not doing well. The group isn't doing well. The stock relative to its peers not doing well. I think that's probably another thing that I would really highlight here, is that the stock, first of all, you got a group that's not good. Then you got the stock not doing well relative to that poor group. And you can see that leads to massive underperformance in the stock relative to the S&P 500. And you're in a group, if you're in mass, you're trying to outperform the index within a space that is wildly underperforming the index. So it just makes trading harder on the long side. So I would pass on Masco.
All righty. The next one is biotech, quite popular, Immunogen, IMGN. I like the look of this chart. It looks like it might be bottoming a little bit here.
Yeah, it's consolidating. Been sideways consolidating here for a bit. So let's pull up the chart and take a look at the key levels. There is your reaction high. I've been asked before, what is a reaction high? Well, basically, it's after a sell-off. Where do you get back to? That's the reaction back to the upside. And you can see we failed at 1150. Notice the last time we got up to 1150, we failed. And all these lows down here, I think, represent really good support at about 975. So I think we're in a trading range and we're sitting right in the middle of it. So I don't really like it. The PPO is flat at the center line. It's just telling us there's really no momentum right now. I will say this about Immunogen, though. On a relative basis, it's doing very well relative to the biotechs, which have been under a lot of pressure. So I think if the group starts to strengthen, I think this could be a really nice play.
All righty. The next one I have for you is, let's see, SYK Medical Equipment.
Is that Stryker?
Mm-hmm.
Yeah, I love the stock. I like the group medical equipment stocks. I know I've written about them and talked about them here on the show, but we got the breakout right there. Could have used a little bit more volume. I would have liked it a lot more if we had a little bit more volume on this breakout, but still pretty nice move. You can see the 20-day moving average. Oops, not sure why that just happened. Let's try this again. Oh, I know why it happened. I hit the wrong button. Okay, so right there, you see these 20-day tests with a rising PPO? That's what I look for. You get this breakout, you got a new high on the PPO. So I'm going to be watching that 20-day moving average. I think price support at 172 and the rising 20-day at 170 provide really nice support on Stryker going forward.
Okay. Next one, just to make you hungry, Domino's Pizza, DPZ.
No, I'm not hungry today. I don't know what's
Oh.
Yeah. Yeah, this is a potential chart breakout. We could have had this one earlier. I like the fact that it's turning up, could use more volume. It's one of two things. It actually could be a turning point too. This one is going to be interesting to watch, see how we finish. And I think it comes down to how we close today. So right now this would be a breakout to a new high, but volume is not confirming this breakout. So if we end up going up here and leaving a tail to the upside, we come back down and close beneath, say 252, 252 and a half. I think that would be a bearish short-term development. I'd still be bullish the chart, but I would not hold because I'd be looking maybe for a pullback back to around that 240 area. So I think today's close will be big for Domino's.
All righty. Let's do this next one for our Canadian friends, one we haven't looked at in a while. I was looking at it, worries me about an island reversal for weed.to.
All right, weed.to. Well, nice breakout. That's the kind of volume I'm talking about when you get a breakout. So let's annotate this and take a look at that. Now, it's not a long-term breakout, but clearly this is, again, what I would refer to as reaction high. You got this pullback. That's as high as we could get for a few months. And then finally, when we made the breakout, look at the volume here. So when I talk about confirming volume, I'm probably talking about maybe 20% higher than normal or more. But you can just visualize this and look and see that the volume bars really picked up on this move to the upside. So I would, again, be looking for support here at the rising 20-day moving average and price support at $34. I think it's going to make another push for this 43, 44 area to test the January high.
Okay. The next one we'll look at is VHI. This is in the materials, especially chemicals, VALHI.
VHI, okay. This is an interesting area for the stock because it did go up on some nice volume. It's pulling back. I think that this is just a wedge kind of a situation. It has pulled back a lot, but I like the level where it's at right now. This was a prior high. Here was the volume expanding on the breakout, which I like. We came back to the 20, moved up a little bit. We did hold on the 20, and then we failed. But the volume was much lesser than what we saw on the way up. I'm going to give this one just a little bit of room here and maybe go to this low from this heavier volume candle at 675. I'd like to see this reverse in the 675 to 7 area. And so a tail coming down, maybe even a little bit below that low with a reversal would signal to me that maybe it's time for a push back to the other side. It could be, quote unquote, a turning point, which we'll be getting to in just a couple of minutes.
Indeed. And the final one we will do is JP Morgan, JPM. I think it's interesting. Could be a flag, but there's just some weakness going on that worries me.
Well, I like the banks. And I think, again, this is a stock that does pretty well. It's one of the better big banks, I think. It's holding up pretty well relative to what's been going on. You can see here that the banking group was going lower. And back in February, you could see that JP Morgan actually was trying to push higher. So I think that was a good sign. But if we look at the relative strength down here, you can see that overall the trend is higher. So let's go ahead and annotate this relative chart. And so for me, this is one thing that's really important, is that overall, even though it has pulled back on a relative basis over the past month or so, I think we've got a really nice relative uptrend in play. So JP Morgan is one of my favorites among the big banks. Unfortunately, the smaller banks are doing better right now than the big banks. I believe that the treasury yields are going to go higher. So based on that theme, I like the bank group. Even though, again, we're not breaking out, we're kind of sideways consolidating off of that high back in January, early February. I believe that this is a group that's going to go higher. So I would be a fan of JP Morgan. What I would look for is number one, I really like the fact that at least for now, it is hanging on to this prior low, and it's also testing the moving averages here, trying to hold on. If it fails, I think we got a shot maybe to go back down to this 106 area, which I think is the biggest support level on the chart. So 106 to 118, kind of a trading range in the middle of it right now. But I think this is an uptrend followed by consolidation, which is a bullish pattern. I think we break out. So I would be a buyer of JP Morgan.
All righty. That finishes up the 10 and 10 to 1.
10 and 15, maybe.
10 and 15. Yeah, you did all right. Not too far off. And so I congratulate you on that. All righty. So you should be seeing the symbols that we went over. I should have those up in the Market Watchers Live chart list, which you can get to by going to the blogs tab. Go to the Market Watchers Live blog, and the chart list link is right there. So you can go look at those relative charts that Tom does, save that chart style for yourself. And with that, I'm going to move on. Let us talk very briefly about ChartCon. It is coming up in August. I can't believe how close we are, Tom. It's getting really down to the wire here. I need to put that briefing together for everybody that I'm going to be doing. I've got it all in my head, though, so we're good. Go ahead, go to stockcharts.com/ChartCon to learn more about our online conference. We do these every other year. So our last one was in 2016, and I know those of you who attended, it was also our very first online conference, very successful. So we, of course, are moving on to doing another one. That means you don't have to travel. That means you don't have to worry about hotels. All of that, you don't need that because you're going to be able to watch this via live stream feed, and then you will get to keep the recordings as well from ChartCon. So you'll have all of those to go back and look at. And I know a lot of people have said, hey, you showed ChartCon 2016 on StockCharts TV. Well, why should I worry about 2018? Well, we won't be replaying ChartCon 2018 on our StockCharts TV. And if we do, it'll be a long time coming. So highly recommend you go ahead and do this, watch us live, and get all of those bits of information about how to reduce risk. And as you can see, we have an amazing lineup of speakers that I'm sure you will love to hear from. And with that, I'm going to move into our final market update, and then we'll get into our last segment. Nope, I did not have my candle glance. So let's go ahead and I'm going to get the candle glance here ready for everybody. This you can get to, as you probably have seen, from the home page. You can also adjust what's in here. So I always like to add the TSX, and I just mix this up for whatever I want to do it. And let's look at Netflix for just today. These are 2-day charts, 10-minute bars, 5-minute bar charts, I think. So you can really get a feel for what's going on intraday currently in the markets. As you can see, a really tough morning. You know, people are saying it was regarding the news between the talks, North Korea being canceled. I don't know about that, but we did have a very difficult morning, but we have been now making way back toward yesterday's close. And in the case of the Russell 2000, which again, we keep seeing relative strength, much stronger than the other larger cap indexes. And we can see that the Russell 2000 has now kicked into positive territory. TSX is sort of lingering below yesterday's close, but I see a very short-term double bottom here that might reverse this trend we saw starting yesterday afternoon. And as far as treasury yields, they were lower on the day, and they are starting to make a bit of a comeback, currently reading under 3% at 2.97. We have UUP, which gapped down, continued lower, but is trying to make a little bit of a rebound, although I can see right now a rounded top forming, so we may have to go down and test these intraday lows once again for the dollar UUP. Commodities lower on the day. USO struggling quite a bit, big gap down, starting to head back up, but consolidating now right about that 1435, 1440 range. Gold gapped up, continued higher on a nice rally, but we're now starting to see some consolidation, hit overhead resistance, I'm guessing, at about that 124 level, which we've been watching. So with GLD, I would see probably we're going to see some more upside movement, especially if the dollar continues to move lower. We can see the VIX started off quite high, a lot of nerves, but now we are pulling back towards yesterday's readings, currently at 1284. And Netflix continuing a very nice rising trend that started yesterday, and we are seeing prices continue in that direction. If I drew a rising bottoms trend line, I'm sure you would see it's sitting right there. That's the 20-day moving average, that blue one. So seeing it hang out right above that EMA is quite positive for Netflix. And with that, I'm going to end our final market update, and we can move into our new segment called Turning Point. And I will let you explain it and start it, Tom.
All right, sounds good. Well, basically, it's a new segment that we just started today, and it's a segment where Erin and I will look for critical junctures on a chart from a technical perspective. It could be a quote-unquote turning point on an hourly, daily, or weekly chart, just anything that kind of catches our eye in looking at charts. And hopefully it'll be an educational segment where maybe some of the things that we talk about on a regular basis but don't have a separate segment for, maybe will be more clearly illustrated. So let's take a look. Last Friday, I'm going to start with Baidu, because last Friday, I remember talking about I was going to give Baidu the Ugly Candle Award. And this was the ugly candle that we had back for last week. We had that false breakout. And let me shorten this so you can really get a close-up on just how ugly this thing was. So if we just do a 1-year weekly chart, and I could annotate. But right here, I mean, depending on whether you use candle bodies or whether you use intra-week candles, you can see that that was a pretty key area of resistance. We tried to get through multiple times here on the weekly chart dating back to the fourth quarter of 2017. Couldn't do it. And then all of a sudden, it looked like 2 weeks ago, we were trying to make that push to the upside. You see the volume was light, though. And I've talked about wanting to see heavier volume on breakouts. Look at the volume expand on the reversal. That is a dark cloud cover candle. And I think, as I pointed out last Friday, I think that was a turning point on this chart. It doesn't mean long-term. I'm not saying that Baidu is going to go, crashing. But when you fail, you've got sideways consolidation, and you fail like this on heavy volume, there's a decent chance you're going to go back to the bottom of the support area, which to me is down closer to about 215. I'm not sure if we get there, but that was a turning point on the Baidu chart. When you get a false breakout, and then you come back down and you post or print a reversing candle, I think that can be a problem. So that was one I wanted to talk about. That's really the only individual stock that I have. So let's move into some indexes. Let's talk about the financials. XLF. Wrote about this one in my blog the other day. I'm going to annotate this because I look for turning points and try to anticipate them before they happen. And if you look at the gap resistance on the XLF, which was roughly this area right here coming across, I think what you'll see is we almost got back to this area in mid-April and failed. We again approached it in late April and failed. We actually got up and touched the gap resistance zone a couple of weeks ago and failed. And then we just did it again 2 days ago with this tail. This was the highest level the XLF had been in 2 months. Looked like it was making a breakout and then failed into the close. Couldn't hold it. 2 days later, it's much cheaper. Now, this may not mean anything to those of you who like to hold long-term, but if you're a short-term trader, that's a very important signal. I don't, as a shorter-term trader, if I think it's going to go down for the next 2 or 3 days, I'm going to get out. I don't want to be in. I can get it cheaper. So I think that these turning points on these charts are really important to follow from a short-term trading perspective. Now, breaking down the financials and taking a look at one of the industry groups, banks, you're going to see a very similar chart when we look at this. Look at the false breakout. Banks moved to a 2-month high, got into this gap resistance zone. It's very bullish if we can get through it. But when you have a false breakout like that, that leads a lot of times to the weakness that we saw the last couple of days. So I think that was a turning point back just 2 days ago, looking back to Tuesday on the banks. Let's take a look at this is outside the financial space, but let's take a look at the heavy construction, which is DJU, or excuse me, this isn't the one I wanted. I think maybe I got the wrong symbol here. Let's try the HV, heavy construction. Here we go. Okay, so where's a turning point here? Well, if you annotate and you take a look, here was the drop, here was the first reaction high, and I want you to kind of take a look at what has been going on as we come across here at this trend line. So we have not been able to get through it, and we have tested this trend line at least 6, 7 times, maybe 10. I mean, if we count it across here, that's a very significant trend line. When you test it that many times and keep failing, when we finally break out, it's going to be bullish. But look at that candle from just a couple of days ago. We had a huge reversal. We're trying to get through the trend line. Look at the volume accelerate, and that big red candle, that is a turning point on the chart, in my view. And we've since been moving lower. I think there's a decent chance that we move back down to test this 415 level. And this is 2 days ago anyway. I thought that was a turning point on this chart. Now, you might be saying, well, okay, these are all nice, but they happened in the past. How about something right now? Let's take a look at the retail or apparel retailers. We've talked about this one earlier in the show. Here's the breakout. Or is it a breakout? We don't know yet. I think if we were to reverse later today, this could be a turning point on the DJUSRA. I would be watching this closely if I was a short-term trader and I owned apparel retail stocks. If we fail and put that tail up there and come back down, probably would be a signal to take your profits and not take any chances and not risk the money that you've earned on this move to the upside. This could be a turning point. Not necessarily. I want to see how it finishes. But again, we've seen enough of these where you get these false breakouts. They look like you have the breakout intraday and then you reverse and move back down. I think we want to be careful here. I think that the PPO on the apparel retailers index is very strong. I really like this group. So even if it does fail, I would expect that maybe a pullback to 840, 845 is what I would look for. And then I would think maybe we'd be at another turning point back to the upside.
All right.
I had maybe just a couple of stocks within the apparel retailers. Let's look at one of them in particular, CHS. This was Chico's, and I want you to take a look at this false breakout. Now, this one occurred 5 or 6 days ago, but this is kind of what could happen to the apparel retailers as a group. See how we were intraday trying to make a breakout above? We failed, came back down. Still a nice looking candle, but we didn't make the breakout when we had the chance. And for me, that's a short-term signal that we're going to pull back. And sure enough, 5 or 6 days later, we come back to the 20-day moving average. Now we're trying to turn back up again. I think this is perhaps another turning point on the chart here with Chico's. I expect we're going to make another run for 1080, but does the apparel retailers group fail today? If they do, I'm not so sure we'll get that run. If they break out, this is a stock I think that could definitely benefit and move back to the upside. So that's basically what I had for the turning point stocks, and I'm going to turn it over to Erin. What do you have?
All right. So I went through, I went through different sector summaries and all sorts of things to come up with my list of turning points. And I was looking for, let's start with this one. I'm looking at stuff that's right about to hit some turning points. And I think that, again, you're talking about where there were some. I'm going to talk about where I think we are in the midst of some. This is looking like a pretty good pattern, right? It's a really long flagpole, a flag. We got the 50 crossing above the 200. So I think there is the upside potential, but I have some issues. Of course, first being a PMO sell signal lining up. The other, and I'm going to switch this chart into a line chart. We can go thick, and I'll take this back down to 6 months. All right. So what I'm looking at in the thumbnail and over here is a double top that's lining up after a really strong run to the upside. So I would not be looking at this as a turning point as far as moving back up. I think we're hitting a turning point in which we're going to see this double top execute, and then we'll get the failure. So the turning point is we've been on this really nice run. It looked like consolidation. But when I look at the PMO, I'm not pleased with the way that's lining up, in this very short-term double top, I think could be a problem. Let's see, KWR, Quaker Chemical. This one I would say is at a likely turning point as well. We were on this really nice price rise, but we're starting to see it broke down below that 5-day EMA. I think that this run is probably over. You can see that we've been in this trading zone forever, from the 160 down to lows of about 140, 250. And I think we're getting ready to go back down in that trading range and test those lows at the bottom of that range. I think there is a few positives to look at here. We do see the PMO is breaking above a declining tops trend line, but you can already see some deceleration here. It doesn't look like this is going to be the one to give you that breakout that you want to see. So I think the turning point here is probably on the negative side. All right, MEI, Methode Electronics. This one I thought was kind of interesting in that, we're just getting a 50-200-day EMA positive crossover, and that puts us in a bull market configuration. But clearly there are some serious problems here. We've had this really nice uptrend, and the stock is getting hit really hard today with an almost 5% drop. I would expect to see lower prices. I don't see this as something that's going to continue. Yes, we're getting that long-term trend model buy signal, but notice the margin is, wafer thin, as I think you would know from, well, there's a particular movie out there. But anyway, wafer thin between the 50 and the 200-day EMA. So I think that will probably fail as well. We're not going to probably make that 200-day EMA. So I would say this is a turning point in looking at the fact that we're just now starting to get hit really hard here. I'd watch this rising bottoms trend line to see what's going to happen. But I suspect we're going to be back into that bear market configuration, and that 50 is going to end up below the 200. I mean, look at that scooter starting to die as well. Parker Hannifin. All right. This one I think is quite interesting, in that, again, the 50-200-day EMA, and you can also see a 20-50-day EMA crossover to the upside. I think this one actually looks good. I think the turning point, we've got the pullback. So I think it's time to turn around here. We're going to sit on that 200-day EMA. We managed to make that work yesterday, and it seems to be continuing in that direction of change, trading above that 200-day EMA. I'm looking at the PMO in total, and I can see that we're finally in the above zero range. The OBV, while we've had a lot of selling right now, you can see there was quite a bit of accumulation earlier. So I think there's some possibilities here that we're at that turning point in the very short term to bounce off that 200-day EMA. All righty, two more. Shiloh Industries. All right. I'm going to look at this one first in terms of the breakout that we got right here. So I think that looks great, but we might be sitting at a turning point here on the downside. But that's not what I want to concentrate on here, because I think this one actually has some potential to continue this upside move. So I think that the turning point here is that consolidation, forming that flag. 50 is now crossing the 200 on a PMO buy signal. somewhat overbought on that PMO, but not completely. And then look at the scooter popping right up into the hot zone as this flag formation started to form. So I'm going to put up the annotation tool quickly, and then we can look at the other one, and I'll wrap it up from there. So there's that breakout, and then the consolidation on top of it. This is the next area of overhead resistance. And all right, so I think that we're looking at least at a move up to that $11 range to test that. And then the next area I'm looking at is this gap that needs to be filled back here. So I think that's also the next point. So the turning point being that we've hit that consolidation. We're now moving into a bull market configuration. You can see everything is lining up a lot better here. And finally, the very last one, WD, Walter and Dunlop. The turning point here, we've got a PMO that is turning up above the zero line, very much like that after a pretty huge decline on that PMO. That is a nice turning point to see. We've got the scooter starting to move up, but what's happening with the chart pattern? Let's go ahead and annotate this and see what we have going on here. I'm not going to include that big long tail there. I want to make my rising bottom line a little bit less steep. And you can see we didn't make a trading channel here. I'd be a little concerned about what could be a wedge in the shorter term. But ultimately, when I look at this breakout and possible hammer maybe forming, I know those are generally positive as we're moving down here. But I like the fact that we've got this PMO getting ready to turn up. I think we're just now hitting a turning point. We've hit, we had the big decline, and now I think that's looking a lot better. And let's take this, and then I will pass it back to you, Tom, for some wrap up. You can see this was heavy overhead resistance even during this period of time. We're now popping up above it. We closed above it yesterday. Looks like an ascending triangle. I'm looking for some more upside movement here. So those were my thoughts on stocks that might be in the process of having some turning points going on. And with that, I'm going to pass it back. It's the end of another show. It went so quickly. Here's what we looked at as far as turning points. Those are the different symbols that we covered. And we hope you enjoyed that new segment. And I guess at this point, like I said, mailbag and wrap up. There was a question in the chat box. Oh yeah, real quickly, Tom. Do you think that, you look at that discretionary staples relative, chart all the time, does it matter to you that the weight of Amazon and Netflix are like almost 30% of discretionary? Does that give you any issues as far as using that ratio?
No, it doesn't bother me. But that is a subject we'll cover on a different day.
Yeah.
No, definitely doesn't bother me.
That's a quick answer, and we'll cover that later.
All right. Why don't you go through the weekly schedule there? Everybody can
Absolutely. It's tomorrow. We have everything. Stock charts. We'll have a surprise guest from the mothership, as we like to call it. Monday, there will be no program because it is Memorial Day. And Tom's got a workshop to start off next week. And we're looking for your, what you'd like to see. And Mark Chaikin will be here Wednesday.
All right, there you have it. Want to thank everybody for stopping by. Please remember to complete that survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday, everybody. We'll see you back here tomorrow. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.